I think it helped. When it became a death practice.
Cindy, you're coming well off my
It'll be on the side.
Spread to that essential. Nobody. Birds, I know. Yeah. Yeah. I like it. I play some. It's a lot of work. But I like it. That's not really much more dangerous. Now it's correct. Digitally, and his doctor's monitoring it all the time. I said, well, how come we don't have something like that? So that's stupid. But so what does this do? You got a card? So this monitors all the vitals? Because I told the doctor, I saw this on YouTube years ago. The guy, the doctor in Florida came up with an app for your phone. You put a band around your wrist or your waist or something, and it's monitoring all your stuff. It sends it to a computer. The doctor sets a criteria. If it goes outside that criteria, a buzzer goes off, and somebody knows to call up and say, are you okay? Or going to see the doctor. And the guy said it's going to save 14 minutes. People don't go into unnecessary things. They do it. Okay, I gotta tell you, my father's 92 years. Doesn't use it. Huh? Well, and actually a lot of people have gone back with because the battery life is next to 4, I get like 3 hours battery life. So what they're doing is they're actually going out and they're buying a flip phone, and then you use your phone, no phone, and then they sell you an additional $10 a month, and you put that in like a tablet or a tablet or something, iPad or something like that, and then you have much better phone. Your battery lasts a week, you drop it in the break, and it's very easy to dial a phone number, you know, and you can still look at your tablet and dial a phone. So this next report is not a good one. So how do I find out about this? I've been looking for something like this for him.
Hey guys, we're gonna get started. Is there any more pizza left? Any more pizza? A couple more slices, I think. There's plenty of drinks back there. Welcome to the Austin Hardware Startup Meetup. My name is David Endler. I'm your organizer for the night. How many of you, is this your first hardware startup meetup? Woo! Nice, at least half the room. And how many of you, is this your first meetup ever? Okay, well, welcome. Thank you for joining us for this momentous experience for you. The way this meetup works, we hold it once a month here at Capital Factory. They're kind enough to host it and to offer their venue. Third Thursday of every month, we get together and usually have 1 or 2 speakers that talk about the journey to building a hardware business, whether that's somewhere on the technical side on the prototyping, somewhere on the manufacturing side, or somewhere in between. By show of hands, how many of you are actively working on a hardware startup right now? Awesome. How many of you are fundraising or about to fundraise? Okay, very topical.
Does printing count?
What's that?
Printing your own money count?
Printing your own money is probably illegal, and we didn't hear it. So the way it works is we're going to start off usually with a couple demos. If you'd like to demo at the next meetup, email us, and we're happy to put you on the agenda. We have an amazing featured speaker tonight, and at the end, we kind of have an open mic for announcements. So I know a couple of people want to just come up and say hi. If you're new to the area, you just want to introduce yourself. If you're looking for a job, if you're looking to hire, if you're looking to promote an event, feel free to come up and just take a couple minutes and tell us more. And then some time at the end for schmoozing and networking. So what I'd like to do is hand the reins over to our demo of the night. It's a company called Simple Booth, and I'd like to introduce the co-founders, Jeremy and Mark, to tell you a little bit more. And then we have some time for questions after these guys do their demo.
Thank you, David. So he told you already we're called Simple Booth. We develop hardware and software. And this is the hardware piece that you see here. Basically, the hardware is created to complement the software, which is used to create photo experiences. Basically, a simple way to set up a photo booth, trying to make a photo booth from a big, complicated novelty into something that's accessible. So, this is mine. Ta-da. Ta-da. So yeah, the ring lighting basically makes it possible to use the front-facing camera of the iPad and create photos that people actually like. Similar to like what you get with a vanity mirror, makes everybody look pretty, washes complexions, and beautifies things. Always giving you the angles. Ooh, it dims. Super high tech.
Beauty is blinding.
Yeah. So we made all of it. We developed all of the EE from the lighting, PCB that powers the light and the iPad and charges everything. And we're trying to further that with more firmware to work hand in hand with the software to control the hardware and sort of create a more enhanced experience for the user.
Yeah, when you get right down to it, it's basically a glorified iPad case that charges it with a ring light around it. But the point of it is that it serves a really powerful business purpose that our customers are willing to pay a lot for, because of how it's done right now. So I'll just take off this here so you can just see how the iPad goes in. It's actually held on with magnets.
Magnets.
And the iPad is held in with little tabs that can actually be flipped around to accommodate different iPad widths. And then you can see kind of our ghetto version 1 of the charging cord hanging out there that we're still working on right now, making that better. Should we go to
Ta-da!
questions?
We select the hardware because it's a hardware meetup. So, yeah.
So then how is this done right now? Is it just, you just take the selfie with the iPad and that's it? Or you said this is better. How is it better than what's already out there? What's already out there?
Oh, okay, so a traditional photo booth, not only is it probably in a big enclosure that you have to like wheel into an event, but it runs, like you have to have someone to set it up and run it because you basically got a PC that's connected with cables to a touchscreen of some kind, which is connected with cables to a camera, and there's just a lot of things that can go wrong with all the different connections. And then you've got like a printer as well. We also offer printing, but we're more focused on the digital experience. So this whole thing can fit in this case, which is relatively easy to get around, and it's lighter, it's more compact. You don't need a huge space at your event to put this up. So there's a lot of small improvements that add up.
How do I get my pictures?
Yeah, so the enterprise version of the app is what we pair with the hardware you see here. This is called Halo. And you go through the photo experience. It's a branded experience, customizable by the brands that are our clients. And at the end, you text it to your phone. You get a custom text message there. Click a link, and you view it in another branded environment from there. So you access and share from your phone.
You have a question?
Why not use another tablet? I mean, wouldn't that be cheaper instead of an iPad?
Yeah, it could be cheaper.
Is there a specific reason for it?
We went with iPad, I think, in part because like the cases are more predictable, so it just alleviates a lot of trying to accommodate different sizes. So we just picked a standard, and that a lot of people are probably going to already have, because that's another huge advantage. We also sell the app to consumers, and so if they already have an iPad, then they're one step ahead. And it's going to cost less for them to get into it and to set up their own photo booth.
Not that there aren't a lot of people with Android tablets as well. But
Does it have any use besides a photo or?
Instead of the internet.
yeah, you could surf the web on the iPad while you could just go to the camera itself and get ready in the morning.
Our main use is for either animated GIFs or photo layouts.
So I wanted to know what did you guys do before designing this photo booth, and how did you get inspired to do this type of design?
We both come from event backgrounds. I'm not talking to the mic anymore. I feel like everybody can hear me. We both come from the event world. Mark had a video production company doing production for events, weddings, you name it. And I was a DJ in the beginning as the photo booth trend was on the uptake, you know. So we both saw that and both got involved in different ways. I brought on photo booths as a service and started offering them for my existing clients, and then just started doing only photo booths because you can scale something that's just a thing. Human DJs are hard to scale. And Mark developed the app in the early days for client needs as well. So that's how we both sort of started to get into the game of photo booths. And then from there, it was all about making them simpler. And that's what the name's for.
Are you guys set up to leave this or to have people do their selfies at the end?
Yeah, totally.
How much does a unit go for?
For the enterprise app with the hardware, together for a year license is $6,800, and the consumer apps are about $60 on the App Store, and the hardware itself is about $4,200.
How much?
$4,200.
Yeah.
The booth, the hardware.
How does it compare to traditional booths?
Oh yeah, so the market for traditional photo booths, like the big ones with the curtain, they can still be anywhere from $3,000 to $5,000. So, considering the simplicity, you don't have to have as much overhead to run it. Brands, that's why. So, being as simple as we are, it makes it so that we can go direct to brands. So they're not bringing in a third-party vendor. In that case, they can send them straight out into the field with people with minimal training, and they can activate them with a lot of ease.
Could this be used for like identification photos, passports, licenses?
Yeah, we've
stuff
thought
like
of
that?
some use cases for the hardware for that too, and then integrating different verticals for the app as well.
See, like Costco a lot of places put your picture on your credit card.
Right, I was there. They have a little webcam with the
Yeah.
PC.
Not a great picture.
You're right.
Yeah.
One more question.
One more question.
Can it fall over?
It's hard. The base is really.
Yes.
Yeah, it could fall over.
I would love to see like a version 2 with a plastic ring around that bulb.
Like a dog collar.
Yeah, please. That's great.
So I don't know if you heard, these guys are going to be generous enough to leave this up and running, so at the end of the night, you guys can test it out, get some selfies.
We could take a group one real quick.
Yeah, go for it. Why don't you guys be in it, and I'll, yeah. There you go.
Oh, we're doing me. That's not fun.
That's awesome.
Sorry, we didn't set it before.
Yeah, you have to share it so we can send it around after.
Yeah, we can do better.
Thanks, guys.
Thanks.
Play with it later. Let me turn the light up. How many of you heard yesterday about what happened to Southwest Airlines? This is actually relevant. Southwest had a major system-wide failure. I still don't actually know what the reason was. Did you hear what the reason was? So literally everyone in the air got stranded. Everyone about to take off got stranded. Poor Kate, coming to Austin yesterday, got stranded in Phoenix. So I just want you to appreciate the level of effort she made to actually get here. Late, but she got here on time, a little later than you expected, but really appreciate you coming. I have talked to my fair share of VC firms in previous lives and venture capitalists, and I can honestly say that the team from Bolt are one of the nicest groups you'll ever find, not even just in the hardware space, but in any technology space. This team of investors could easily not be as giving to the communities that they go out and outreach to, but they're wonderful in an area, I guess, of hardware development that needs all the resources that we can get, especially in cities like ours where we don't necessarily have the resources of, say, a San Francisco. So we're really lucky to have Kate McAndrew here. So Kate's an investor at Bolt. She'll tell you a little bit more about where Bolt is and what they do. Previous to Bolt, she started an accelerator in digital health startups, and she's also the founder of Women in Hardware, which is a group that promotes talent, investment, and connections to women who are working on the future of hardware. And if you want to know more about that, I'm sure she'll tell you. So please give a very warm welcome to Kate McAndrew.
That's such a nice introduction.
You deserve it.
Yeah.
Can I stop computers with you? Okay. You guys are gonna see my dogs first. Aren't they cute? They look like twins, right? But they're not. Okay. Cool. Hi, I'm Kate. That was such a nice introduction. Thank you so much. I love Texas. super excited to be in Austin, really excited to meet you guys. I thought I would just tell you a little bit about Bolts, a little bit about kind of who we are, what I'm thinking about, what I'm excited about, go through some kind of trends that we're seeing in the hardware investment space, talk a little bit about raising initial capital. I think most of you guys are in kind of the early stages of product development, of fundraising development, and then just do as much Q&A as you guys want to do, or as much as our host will allow. So that's my plan. So Bolt, we are venture capital designed for hardware. That's our mission. Our only desire is to help amazing companies kind of at the intersection of hardware and software get off the ground, particularly from the earliest stages. So at a tactical level, what that means is we are writing checks in the $100,000 to $500,000 range. Most of our fund is focused on what we now call pre-seed. So we're often the first institutional investor or the first professional investor, first fund coming into a company's round. We often follow on in those investments. So unlike an accelerator or an incubator where it's kind of, you're in for a certain amount of time and you got the standard deal and you're out, we act a lot more like a VC where we want to stay involved, stay hands-on, follow on in subsequent rounds. And then we also participate in select kind of seed or Series A type rounds as well. We have a pretty strong thesis in the hardware world around recurring revenue. I'm going to talk more about that, kind of about what we think of as kind of like old hardware and new hardware. We get most excited about new hardware. But that's kind of an overview of who we are and what we do. I thought, so in looking at VC firms, I think there's kind of two things that are really, really telling. I think you can look at a firm's portfolio and kind of understand from the portfolio what the firm's all about. And you can look at kind of the investors and their backgrounds and who they are. And those are kind of the two entry points to really understand what a firm's all about. So I thought I'd pick sort of 3 deals that we've recently done that I'm excited about and tell you about those to give you some insight into us. And I think as I talk about hardware trends, you'll get a sense of how that all ties together. So this is a company in San Francisco that we just invested in about 6 weeks, 2 months ago. It's a really fresh deal for us called Byte. They have what looks like a glass fridge, but it's actually tricked out with RFID sensors, and they put it in break rooms of offices. So offices that are not Google, they don't have their own professional chef kitchen, but they have a population of people that want good, healthy, fresh food. The office actually pays Byte $500 to $1,000 a month just to have the fridge there. And then Byte sources healthy, fresh, delicious food, sticks RFID tags on that food, fills it in the fridge. So at lunchtime, you can just walk into the break room, swipe your card, swipe the card, fridge scans what's in there, you open the door, you pick out whatever you want, close the door, the fridge scans again, and then it figures out what you've taken and it charges you for that. So that's Byte. Vitameter, so I'm also really into kind of consumer health. I started an accelerator in the health space, so I got excited about consumer health stuff, so food, vitamin testing, you'll see a trend there. Vitameter is another company also based in San Francisco, but when we invested in them, they were actually in Waterloo, Canada. Super interesting technical team. And what they're doing is taking some technology that's been in the lab, and they're trying to bring it into people's homes. So there's existing technology that allows you to take a very small blood sample and assess right now what your vitamin D levels are. They're also unlocking vitamin B and some other kind of critical vitamin levels for health. And then, so basically they take that sample at home, so you can prick your finger. They'll tell you what your vitamin deficiencies are, and then let's say you need vitamin D or vitamin B, they'll actually mail you the appropriate vitamins, or give you the opportunity to order them on your phone. And that's kind of tapping into that whole kind of health and wellness sort of trend and kind of what's going on with healthcare and moving it into people's hands.
Minerals too?
What was that?
Minerals too?
Right now they're really focusing on vitamin D. They think that's kind of the entry point to the market, and then I think they'll roll out subsequent things after that. I don't know what minerals are on their path, They're going for FDA clearance. They really want this to be, yes, a wellness device, but really a health device. So they're only going to go after things that they feel like they have clinical efficacy around. I think there's a lot of like squishy weirdness in the vitamin space and the mineral space, and they want to avoid that and really sort of not be a diagnostic tool, but have the kind of weight of a true diagnostic behind them. I'm going to talk a lot about business models. So just here, 2 things to point out. They have 2 sources of recurring revenue, as did Byte. So they have recurring revenue on the test strips, and they also have recurring revenue on the vitamin sales. Byte has recurring revenue on the fridge lease, recurring revenue on the food. So those are kind of 2 different types of revenue for each. Concrete sensors. So this company is awesome. I think that there are really interesting business opportunities outside of the sexy health and wellness categories. So industrial automation, construction, there are some really interesting businesses being built there. Concrete Sensors makes a small sensor that basically gives you core intelligence around what's going on with concrete as it cures. So the sensors get tied to the rebar in a wall or in a floor system, and then the general contractor or whoever they're working with that's managing the concrete, instead of having to drill core samples and things like that, they actually get data of what's going on with the concrete right to their phone, which gives them the ability to save time, save money, which in construction are the 2 things you want to do. These are disposable sensors, so they end up living in the wall. Great recurring revenue, and people have to keep buying more as you build things. And it also helps that they're in a multi-trillion-dollar industry. So, different business model than Vitamin, or different business model than Byte, but kind of same concept of not selling one thing for a margin, but kind of that ongoing relationship with the customer after you've hooked them. So I thought I'd just show you our offices. We try to be kind, good people, and maybe that's a little different than VCs you've experienced. I know lots of wonderful VCs. We also have a pretty different looking office than most VCs. We started in Boston 3.5 years ago. Our first fund was tiny. It was $4 million, which in venture capital is like pigeons. We raised our second fund, I guess, 1.5 years ago, and now we have $37 million under management. And that's when we opened our San Francisco office. This is our shop in San Francisco. So both offices have not only our investment team, which is 4 people, but we have full shop resources from CNC to 3D printing and laser cutting, electronics labs, welding, you name it. And the goal there is really to provide hardware startups, early stage hardware startups, with all the things that they need to get to market quickly. And for us, that's resources, that's space. You can't start a hardware company at Starbucks. And access to machines, and then also expertise. So in addition to our investment team, we also have a 6-person engineering team. So mechanical engineers, electrical engineers, industrial designers, prototypers, that work with our companies to help them kind of see around corners, fill in gaps on their team, and train up the portfolio to be able to ship a really scalable product. So that's our space. So that's a little bit about who we are and kind of contextualizing where this is coming from. So I wanted to talk about why are VCs open to hardware today? I think when we started Bolt 3.5 years ago, it was not super fashionable to be doing hardware. It's getting better, which is great. I think there's I hear the word IoT, every second sentence now. But there's some kind of bigger trends in play that I just wanted to talk about. So what's VC about? Investing is about returning capital at the end of the day. I mean, to us, I think when I think about why do I do what I do, it's about you guys, right? I literally think it's a privilege to get to give people money to help them build their dream. That's what investing is about to me personally. But what is investing about at the end of the day? It's cash on cash returns, right? So in order to get people excited about deploying more capital, you have to show that you can have returns on that capital. And so we've seen, over the last 5 years, some pretty incredible returns that debunked a lot of the myths about hardware startup valuations and return potential, both on the consumer side and on the B2B side. And I think that that's really driven by what I've been talking about, which is this shift in business model. Jawbone did a lot of things well and did a lot of things, I don't want to say poorly, but there are some real lessons to learn from their business model. So they were definitely trailblazers in terms of product category. Like they invented the Bluetooth speaker, and that's a really incredible thing. But if you go on Amazon, there are over 150 results for Bluetooth speaker, and they didn't have anything defensible about what they were doing. And I don't mean defensible like defensible technology. If you think about Beats, like that's all about brand, right? There's a lot of ways that you can be defensible, but Jawbone was really in this place of kind of that race to the bottom of commodification. And that's only even more and more true looking at sort of the maturation of the Shenzhen ecosystem. If you think about drones, like we're starting to see, incredible, I don't want to say copies, but similar products of these sort of straight hardware products coming out of, US companies, but also Chinese companies. So I think Jawbone is a pretty instructive example here around that kind of what I would say is the old hardware model. So even if you pioneer a whole new category, if you don't have something that is going to keep people with you specifically, there's a real risk around getting commodified and that not giving you the staying power to have the kind of growth that you need in order to build what I would consider a venture scale business. That doesn't mean you can't build a business. There are businesses to be built, but it just means that it might not be the right fit for venture capital. And I think that that's a really important question to ask yourself when you're thinking about your product and the business that you want to build. So a big part of this too is, traditional kind of consumer electronic cycles run on this 18-month end of life. So basically that's kind of how long you have with a product in the market before you get to turn around and give people something new. And that's a really tough pace to keep up with. It also cycles heavily around Christmas. So if you have a crisis and you miss Christmas, you're dead. And that's just, a tough thing. So today's hardware, I talked about some examples from our portfolio, but stepping back, I think today what we're seeing and what's really attracting venture capital dollars are these Trojan horse businesses where hardware is really a Trojan horse for something else. Oftentimes that's software, sometimes it's a consumable. I'll talk about kind of different business models. But the point is that hardware is the enabler, not the end product. And you see that both on the consumer side, in the enterprise, and in the industrial setting across the board. And with products that have that kind of recurring software layer, you see expected value over time growing. If you think about Dropcam, for example, you buy a Dropcam, but you keep getting recurring revenue with that data storage over and over and over, and that customer's value grows over time. So that's just a fundamental difference between selling something in Best Buy for a margin and having to sell something else to that same customer in 18 months, that I keep making that sale, keep acquiring them, versus this, okay, I've got you, and I've got something that you're just gonna keep paying me for because you love the experience, and it's now just a part of it. So I think the difference in those graphs is important. So hardware plus software really is, I think, the great sort of hope against commoditization. And so Dropcam, for example, harder to replicate, I talked about that. There's also a sense of increased switching costs. So if you think about products that have, like Fitbit has all of my data, right? Like I pay for the premium subscription, and they've got, my weight for the last 6 months, they know like everything about my sleep, and so I don't want to switch to another tracker or another health, quantified self sort of thing because Fitbit owns my data, right? And so there's really a friction there against me leaving. The other point too is now Fitbit's got a universe of devices. If I own the Fitbit, I'm more likely to buy their scale. I'm more likely to buy other products that are sort of in this universe of products. And I think that creates some really interesting opportunities to kind of fill out what the device is in someone's sort of personal ecosystem. You also get more touch points. So I think GoPro is a great example of this. So every time somebody uploads a footage from GoPro or shares footage from GoPro or sees footage from someone else's GoPro, that brand is getting all of these touch points with consumers and potential consumers, and they didn't have to do anything for that, right? Their product kind of had some inherent virality to it that I think, despite being a one-time sale, that sort of feature, or the fact that it was this video sharing thing and they really nailed marketing, and that's what they said they were going to do better than anybody else, is one of the reasons why they were able to IPO, although finances now not looking so great. Network effects are another thing. If you're familiar with Tile, or actually GoTenna is a better example. Who here has heard of GoTenna? A couple people? So the idea with GoTenna is I can have internet anywhere. So if I'm going hiking with a friend, I can turn it on, and then we're able to message back and forth. So if I have a GoTenna and you have a GoTenna, and we're going to go hiking, and you're going to come with us, and if you come with us, oh, it's so cool, like they can message back and forth on the mountain, blah, blah, blah. Like when you are thinking about maybe getting something to enhance your outdoor experience, if we already have GoTenna and we go hiking together, like you're more likely to buy that because there's compatibility within the group, right? And so that's sort of what we think about in terms of like hardware network effects. Tile is another example of that. If a bunch of people have Tile, it's more likely that someone else's Tile is going to see my stolen bike, right? So the individual product experience grows as density grows. So all of these things are touching on sort of these recurring revenue hardware business models. And I think this is one thing that I would love to see people have more specificity around as they're pitching in the early stages. Not because you have to know the answers of exactly how your business model is going to play out, but because if you haven't thought through this fully and thought through how customers are going to receive or buy or continue to engage with your product, it's a really big red flag for investors. And I see so many people come to me and say, okay, we have this hardware thing, and people are going to pay us $7 a month to use it. Because they know that we want to hear about recurring revenue. They know investors want to hear about recurring revenue. But like, how many things do you really pay for monthly? Like, I pay for Netflix and I pay for Spotify, but I like really thought about that Spotify. There are only so many things in our lives that we're gonna have that attach rate on. And so I think thinking through what the business model is super important from a customer's perspective, and it's also super important from a sales perspective and from just a cash flow management perspective. Because in hardware, you have to manage cash. So hardware as a service, this is seen a lot in B2B companies, business-to-business companies. So typically you're selling some piece of hardware up front and making a margin on that. And then you're also making some kind of recurring revenue on the software. We have a portfolio company called DipJar that fits into this model. So they make a little device that sits at the barista countertop, and coffee shops buy that device, and DipJar makes a little bit of money, not a ton of money, but a little bit of money on each device that they put into each coffee shop. And then it's a tip jar. It's a tip jar for credit cards. So every time somebody wants to tip the barista, if they don't have cash, they dip their credit card in. And every time, DipJar gets a very small percentage of that tip. And DipJar manages on the back end, making sure everybody gets tipped out appropriately and does a lot of that kind of enterprisey stuff that's important. But that would be sort of a hardware as a service business model. Hardware-enabled services are similar but different. So Fitbit is an example, I already mentioned that. Dropcam is an example. So Fitbit, I didn't pay anything kind of recurring up front. I was sort of like, okay, I'm gonna buy this tracker and that's it, right? But then I decided, okay, I really want these extra features, and so I started paying recurring. And so that we would call sort of a hardware-enabled service. I buy the hardware, I want more of a service, so I upgrade or I get premium features. And then consumables, which I think is one of the most exciting. People sometimes talk about, the Keurig model or the razors and blades model. So it's basically I buy this one thing, and then there's some kind of consumable piece to that I need to keep on buying or that I want to keep on buying. And I think that want is actually really important. So if you think about Keurig versus razor blades, Keurig, the point, or let's say Kindle. So the point of Kindle is that you want books. So when you go to buy the book, it's like really exciting because you want the book. Like I don't know if anyone really wants razor blades, I'm not like, man, Razor Blades, I'm so excited about that. But you want the book, or you're excited about the coffee. You want to try this new type of coffee or whatever. And I think about Bite in the same way, right? About that fridge. Like I'm excited every time I get that salad or that sandwich. Like that's a consumable, and it's very literally a consumable because you eat it. But like that's a great example. They kind of have a hardware as a service model plus a consumable model in one. So the investment trends, I wanted to kind of go over these a little bit of data. So in the last year, hardware companies have raised over $1 billion collectively. We saw a huge explosion between 2010 and 2014, and a lot of that was driven by those IPOs that I laid out earlier. There's been a lot of talk in the Valley, and I don't know if that conversation's happening here, but about kind of a slowdown in investment, and we haven't seen that. In looking at the data annualized, so this is just up until now in 2016, then when you annualized it out for the rest of the year. 2016 outperforms 2015 a little bit, so it's not a huge amount of growth, but it's not a huge slowdown. It's likely because a lot of the slowdown we're seeing on the software side is driven by kind of unicorns collapsing. There aren't a lot of hardware unicorns right now. So that's just my personal take. But basically, funding is still happening, and we're not seeing like a huge crash or a huge stop, at least in the early stage hardware stuff. This is hardware startup investments by region. San Francisco really blows everywhere out of the water. New York and Boston combined make up about the size of San Francisco. Austin is unfortunately not on here. Would love to see more activity in Austin. But I think that while this is sometimes hard to sort of think about when you're not in San Francisco, or you're not in New York or Boston, I also think it's important to understand when you're thinking about raising capital. If you're pitching people in the Valley, they're going to view you as being in a secondary or tertiary market. And I think when you're pitching your company, the most important thing you have to understand are like, what are my strengths and what are my liabilities? And there's a lot of advantages, I think, to being in a place like Austin when you're starting out. But if you're going out to raise big rounds, you want to understand sort of like, how is this investor going to see me? How do I best position myself against those assumptions? And sort of understanding what geography means for that is really important. I think that people understand that Austin is on the map, so it's not like, it's a random pitch from Guatemala, not at all. But I think that when you're thinking about what your company is and how much money you're going to have to raise to make it successful, that's really important. And the other thing too is to think about maybe what you need to do is get on a fast path to profitability. There are a lot of ways to build a company, and it doesn't come from necessarily just raising big rounds of venture capital. Sometimes it's great to raise small angel rounds, get to profitability, and go to private equity. There's a lot of ways to kind of go about building a business. But if you're building a business that you feel like you're going to need, $50 to $100 million to build, you want to think about, where's the money, or how do I position myself appropriately to be able to build this company and raise the amount of capital that I'm going to need to raise for it. So the other trend that I want to talk about is sort of this invention of pre-seed. I described ourselves as a pre-seed fund. Like, this word did not exist. It's important to remember that like venture capital as an industry is like actually really young. Series A rounds used to be $500,000, and now like in VC, things have really what we would call kind of moved up the stack. So funds that were young and were successful started raising bigger and bigger funds. If you have bigger and bigger funds, you have to deploy more and more money. There's only so many deals out there, and there's only so much time for you to work on those deals, which means you have to start writing bigger and bigger checks, which means that someone that was a seed fund is now really playing in a Series A. Someone that was maybe a Series A fund is now looking like a B or a C or a growth fund. And so a lot of the funds that used to be sort of seed funds are now moving sort of further down the line, and it opened up what we would call pre-seed. So when we talk about pre-seed, or if you see pre-seed out there, or if this is you, this is what people are calling it these days. And it's silly, it's all language, but sometimes it's helpful if you can kind of speak the lingo. So I thought NextView had a really good definition. They actually have a lot of great content online too, if you're wanting to learn more about this stuff. So basically, pre-seed is an early round of financing that's designed to help a company achieve certain intermediate milestones prior to the magic combination of product market fit and meaningful traction. So what does that mean? Typically, it's less than $750,000. So we say you're pre-seed, if you're raising angel money, maybe it's micro VC. We're considered a micro VC, so that's typically a fund under $100 million. That's kind of the dollar amount range. After that, you're kind of raising a seed round. In hardware, typically a pre-seed company that's coming to us, we see a lot of these, usually they've got a working prototype. They might have a couple out there that they're testing with people, and they've kind of hacked together, they've gotten some feedback, they think they kind of know who they're gonna go for, but they don't necessarily, they're not at EVT. Typically, we see people who are at EVT sort of ready to raise an A, even better if they're actually shipping. So that's kind of when we think about where you are in terms of product, it's like working proto. And typically a pre-seed round is followed with a larger round in 12 months. So some people will raise 750K, get a bunch done, they'll raise a seed round, 1 to 3 million, and then with that money, they're gonna get to like that really big, maybe $7-10 million A round. Again, I'm talking about the traditional venture route. This is, that sort of, that path. There are other paths, but I'm talking about this path. So that's kind of what's typical there. And I can dig into this more after if people have questions about it. There's also a trend of kind of micro VCs that are really specialized. So there's a whole host of, VC firms that like only do, a certain level of middleware, enterprise software, selling to unicorns made of cow. I don't know. They're like really crazy specific things. So hardware only VCs, here's a couple of us. We're all friendly. We're all in San Francisco. Everybody talks. So we share a lot of deal flow. And then there are also other funds that are hardware friendly, and we actually have a great infographic on our blog that shows all of the companies in hardware that have raised over $1 million and who invested in them. So it's a great resource if you're thinking about how to create a target list of VCs to approach. The infographic is a great place to start, and we're going to actually submit or publish an updated one soon. So wrapping up, VC literacy. So weird thing about VC is it's really not that complicated, especially in the early stages. But I think a lot of the knowledge about it is like locked up within communities that haven't traditionally shared it. And it's not really taught in school. And it's kind of like this secret club. But the good news is, one of the trends in VC, because there's been so much money, is that everyone's now competing for deals, and so people have started to market themselves, and started to market themselves with really good content, which means there's great resources out there to learn about VC, to kind of understand what the process looks like, to get sort of insight into how decisions are made, into kind of one of the things VCs worry about. We have to fundraise too. And so these are some of the things that I personally find really useful. There's the #1 book, if you've never raised capital before and you're planning to raise capital, would be Venture Deals that Brad Feld wrote. It's phenomenal, and the whole point is I think it's like be smarter than your lawyer and venture capitalist, and it just really breaks down, term sheets and all of the kind of nitty gritty of fundraising in a way that I think is super important and can kind of give you that language and empower you to know the questions to ask and know when someone's bullshitting you. And my other 2 books is The Hard Thing About Hard Things by Ben Horowitz and 0 to 1 by Peter Thiel, both sort of about the entrepreneurial journey and the investing journey. Fantastic books. They're all fast reads. There's a great podcast called VC20. They're 20-minute podcasts with great, fantastic VCs. Listen to them in the morning. They're great. Strictly BC is kind of the Valley rag that gets sent out every day. The other one's Term Sheet. I personally read Strictly BC. And that just shows you, it's usually an article, but then it's just who's getting funded and for how much by who. So if you're going to be fundraising and you're thinking about approaching people, it's a really great way to kind of get in the cadence of like who's investing in what, like what's going on in the investment kind of ecosystem. And so I really recommend that, and it's also funny, which is great. And then Mattermark is a basic. So that's all I have, and I'm super happy to take questions. So shoot.
Okay, you mentioned pre-seed and seed. Could you give some overview on how those are structured financially?
Yes, I'm gonna take my jacket off because, God, you guys, Austin is hot. I don't know if you know this quote by Mark Twain, but he said, thank you. He said the coldest winter I ever spent was a summer in San Francisco. It's totally true. Not true here. Yes, so typically in a pre-seed, there is two structures that we see. Usually it's a convertible note or a safe note. So those are both instruments of debt, which means that, let's say you're raising $100,000. You're gonna say, okay, angel investor, we're gonna do a convertible note for $100,000, and there's usually three terms you wanna be aware of. You wanna be aware of the cap, which is the point at which the note converts, which also helps to kind of set, or is a benchmark for the next financing. The discount rate, which is the discount price at which that $100,000 investor is gonna get converted to on the round that happens after them. Typically it's 15 to 20%. I've seen as low as 10, that's uncommon. And then the interest rate, which doesn't really matter if things go well, which is usually around 6%. So convertible notes and safe notes, YC invented both and has primers on both online. So if you're wanting to learn more about safe notes and convertible notes, they have sort of things, open source documents that walk you through each of the terms. Venture Deals also walks you through each of the terms. But typically that first $750 is raised on some kind of debt vehicle, usually convertible note or a safe note. When you get to a seed round, sometimes it's convertible notes and safe notes, sometimes it's what we call priced round. And the big difference there is you're actually setting a true valuation for the company. So you're saying, this company is worth 5 million pre-money valuation, or 6 million pre-money valuation. Whereas in convertible note or safe note, you're kind of kicking the can down the road to say, we're gonna say it's worth no more than 5, but we're not saying exactly what. The thing is that today, the cap kind of works like a valuation anyway in terms of the next round, so it's not that big of a deal, but yeah, hopefully that answers your question.
You got into concrete sensors. I could have sworn that I saw them advertised at least a year ago, maybe 18 months. So did you get in late, or they weren't brand new when you got in?
So we were one of the first investors, and we just followed on in their seed round. So we did their pre-seed and then followed on their seed round.
And then the next question is when is the Austin office opening?
Right now, we don't have any plans to add locations. It's we have a huge team for the size of fund that we have, and for us to cover more geography physically would be pretty tough. We do our best to try to come to stuff like this, and we also spend a lot of time kind of writing our blog to try and reach broader audiences, but most of the time we have to spend in San Francisco and Boston. But I appreciate the question.
I noticed with the little speaker devices, which I have some of, the Jambox did not have particularly good sound, where JBL and Bose came out with products that sounded much better. So is the real issue over time who produces the quality of product that people want?
Usually not, honestly. Usually not.
So what is the criteria?
Criteria for what?
So JBL and Bose became very successful, Jambox did not. I thought it's because they sounded better. Is there some other reason why more efficient marketing because JBL had a bigger, Bose already had a bigger universe or something, or what?
So I think I hear your question, and I think that quality does matter, and you can't produce a shit product. But I think that the counterexample to that would be Beats. So if you look at Beats, those are not the most amazing headphones in the world, right? Bose's headphones are much better than those headphones, but that brand freaking owns.
That's fashion, though.
Yeah.
They sell fashion. They don't sell sound. Bose sells sound and fashion, but Beats sells fashion.
Sure, so I think that when you're thinking about a product and what makes a product successful and what makes a product sticky, there are lots of axes upon which you can compete, right? Sometimes it's quality, sometimes it's brand, sometimes it's something else, shareability, whatever. And when we think about competitive analyses, we typically look for people to draw them on two axes, an X and a Y axis. And we want to understand what are the two axes upon which you are competing and how do you win by doing that, right? So Beats wasn't competing on quality. Their headphones had to be good enough, but only good enough for their brand to win, right? And so I think that the point about the Jawbone example isn't so much about quality as it is about the defensibility of the category. They weren't able to defend the category. And I don't believe that was because of quality.
So why couldn't they not defend it?
Because it was easy to copy.
But that still doesn't answer the question. You know?
Sorry?
Was the defensibility a lack of patents?
No. I don't think so. I mean, that's a very hard thing to get, like, tried and true patents around. It's not that unique, frankly.
Can you talk about your all's ownership when you come in and invest? How does that work?
Yeah, so we don't have kind of like a straight deal structure. Everything sort of depends on the company, their stage, how much they've raised previously, et cetera. Typically, to be super transparent, we do a split securities deal, and we'll be investing cash on a convertible note or a safe note. Sometimes that's existing, sometimes we're the first ones. And typically we invest 100 to 500K, as I said, on that note. And whatever the terms of that note are dictate how much ownership we get from the cash. And then we'll do a straight stock purchase agreement for a certain amount of common stock. And that's driven by kind of how hands-on are we going to be? Is the company going to be moving into our office? Are we going to be starting from the bottom with them and really working on product architecture, probably working closely with them for a year and a half or more? Or is it more they're farther along, they need some help with kind of DFM optimization, they're going to be in their own office, in which case we would take less common. So that's kind of a sliding scale based on how much of a hands-on engagement we're going to have.
What kind of revenue markers are you looking at before investing?
So I think we've invested in two companies that have revenue. I mean, the vast majority of the companies that we invest in and that we look at don't have revenue. And that's absolutely, at the stage that we invest in, it's basically never.
And what do you want in return? No, I mean, you're not just loaning money like a bank. What did you?
No, so venture capital is based on the premise that we give people money in exchange for a piece of their company. And so we're buying a piece of the company in hopes that the company will exit either through an acquisition or through an IPO, and that we'll get returns on that cash. That's the basic premise of
That I
VC.
understood, but how big a piece,
I think I just described that in fairly specific detail.
So how many of the companies that you guys worked with in the early stages are pursuing IP or patents? Do you have a ballpark percentage?
Yeah, so 10, 15. So here's why. So there are some companies who are often, and in that 10 to 15% category, who are typically taking some kind of technology out of the lab or out of a university. And sometimes they're getting exclusive license to that patent, or they were in that lab themselves and they have the patents and they're bringing that out and commercializing the device. On the flip side, for most of our companies, we really believe, and I think that the lawyers that we work with would agree, because we believe it because they believe it because they're our lawyers, that you want to patent real things And since we invest so early, a lot of material things can change about your product from sort of your V2 prototype to what you actually ship with. So filing provisional patents is super important, and you want to make sure that you're looking at timelines and filing provisional patents. I'm certainly not a lawyer, so I'm not going to give you specific advice on that, but I can refer you to people. But in terms of having like full IP, that's not something we advise people to spend money on up front. Really wait till you know what your product's going to be, and then go for the full patents.
What are some red flags for your firm when evaluating companies, and also what are some really positive signs that make you think, okay, this is a company worth investing in?
That's an awesome question. It's a really, really good question. So I'll tell you some red flags. None of these are deal breakers, right? So there are red flags get flown. It doesn't mean that the deal's not going to happen, but these are things that are kind of like, ooh, not so sure. First one is founders aren't full-time. Another one is like family members or husband and wife teams. That tends to be a little bit of a red flag. Split teams, so people working over like 2, 3, 4 geographies. We tend to like to see teams that are really close in one place. The exception being sometimes there's like a business marketing office, and then maybe they're doing a hardware development somewhere else, but we still prefer the team in one place. Those are kind of basic things. I think bigger than that is not being able to articulate your market opportunity and not knowing about your market. So a lot of people, especially in hardware, get really excited about the hardware, and that's great, and we empathize with that because we love hardware too. But it's our job to invest in a business. And so we really want people who, yes, that you can talk the technical talk, and you understand the product, but really, really want people who are thinking critically about the business. And if I'm starting to ask you questions about, well, how many bodegas are there in the US, and you don't know, like that's a bad sign, right? Because if this is going to be your business, you need to know. And that doesn't mean you have to know every specific market number, but we want to know how you're thinking about that. So not knowing your market, not having thought critically about your business model, kind of the little red flags around like family or kind of team formation issues. Another thing is founders not having enough equity, although that tends to come up much later in the diligence process. Not showing up to meetings, being late, things like that. Not being able to articulate your technology, even if you're a non-technical founder. Like I'm not an engineer, but I need to be able to understand the technology that you're talking about, and so it's important to be able to explain in plain English what you're doing. So those are some red flags. And then, so your other question was really positive things. It'd be like the flip side of that. Right? So the two kind of big things are like, is this person credible? Do they know what they're talking about? Are they confident in what they're talking about? And do I believe them? And then, do they understand this business? Do they have a vision? Are they able to articulate where the world is going and how what they're building is a part of that, or is going to enable that? And really telling that story is important.
Kate, how big is your current fund? And if someone here, I assume you're still investing?
Oh yeah.
If someone here doesn't catch you in the elevator ride down or catch you after, what's the best way to pitch you guys?
Yeah, so
first of all, how big is your current fund?
So we have $37 million under management, and we are about 40% deployed. So we have lots of capital left in this fund to deploy. That's my email, kate@bolt.io. Unlike a lot of venture funds, we actually read every single inbound pitch that we get. So you can send in a pitch through our website and attach your pitch deck, and we will read it. I would say out of all of the pitches that we get, we probably take a first meeting with about 20%, maybe 30%, and then a second meeting with about 20% of those companies. So that's kind of the funnel breakdown if you're thinking about where you are in that process. If you're interested in Bolt, if you want to pitch Bolt, please send in a pitch through our website, bolt.io, and just put in the subject line or in the little message that, hey, saw you at Austin Harvard Meetup, and I'll be sure to take a considered look, and I'll do my best to send a lot of feedback if it's not warranting a meeting and tell you why, or take a call and learn more.
what do you look for in the pitch? Just email, essay, or picture slides?
Sure. So, yeah. So the deck is actually really important, and I think people talk about that a lot. And I sort of thought it was bullshit until I was on the VC side of things. But the truth is that it really is kind of an amazing predictor of the quality of company that you're talking to. And I think the reason why is by the time that you're coming to talk to someone that professionally invests money, like you really need to have thought through the core questions of what you're doing. And you can't have a well-articulated investment deck unless you've done that. So there's a silly thing that's like a little tell. File type is an interesting predictor of quality. I'm not kidding. So the highest, I would say, like best, like what I want a PDF or I want like a doc send. The bottom of the barrel is like a Word document. So like PowerPoint and Keynote being in the middle. So if you're sending your pitch, that's because I could be opening it on my phone. I could be, you don't know if I didn't have PowerPoint until, do I even have PowerPoint? I don't know. So all the slides get messed up. So like send a PDF or send a doc send. And then the other thing is there's a ton of advice out there on good slides. I think actually NextView, who I quoted earlier, has a really good kind of like template. But the basic things you want to cover, typically a 10 to 15 slide deck is good. The things that you want to cover are, what's the problem? How do I solve it? How big is this problem? What's the size of the market? How am I specifically addressing this? Or like, who am I going to go after first? Like, how do I segment this market? And then what's the business model? So how do I make money off of putting this solution in this market? How are we different than who's out there? Who the heck are we? Team slide. And then, product, proto, like it's great to show photos of prototypes. Like it's great to see that people have actually built things. We tested it with this 10 people, they love it, here's what they said. And I think that like telling that basic story is what you need to do in an overview. Some people will send like a teaser deck, like 3 slides or 4 slides. That's okay if it's really good. If it's kind of well designed and you've got core information. It also helps if you have a strong background, like if you have a strong founding team. Executive summaries or one-pagers are okay. It's harder for me because if you think about the number of pitches that I review or the kind of throughput that we have to go through, like a deck just tells me so much more, so I'd rather get a deck. An executive summary is okay, but it's kind of harder for me to ingest the information, and like we're lazy, you want to make it easy on us, to be quite honest. The other thing so Chris Quintero, my wonderful friend and colleague, wrote an amazing blog post about pitching your startup like a Hollywood movie. I think it's like a great post, and he kind of talks about like understanding who you are. Like, are you a blockbuster film or are you an indie film? Do you have an all-star cast or is it up-and-comers? Have you like raised lots of fancy capital or is it like a scrappy budget? And like figuring out how to pitch your story kind of based on who you are and where you're positioned is really important. That's kind of what I was talking about earlier in terms of like know your key liabilities, know your strengths, and communicate those.
Okay, sorry, I have one more question so valuation. You talked about ownership a little bit, but valuation, if you don't have revenue, which it sounds like a lot of your portfolio companies don't, how does that negotiation or discussion go? I assume founders want as high as possible. You guys want reasonably low to make it worth your while. How do you come up with that number? How do you guys come up with that number?
I mean, it's mostly bullshit, right? On everyone's point. Like, there's no revenue. Like, it's mostly bullshit. So it's really kind of what the market will bear, and like the investor that's negotiating that term sheet with you. So some people are more price sensitive than others, and that's driven by lots of things. I would say, we see common valuations for pre-product startups would be and this is in, let's say, the Bay Area is definitely higher than Boston, but I'm mostly looking at deals in the Bay Area, so I'll tell you those. So I'd say $4 million on the low side, and we have seen them up to 12 or 18, which is crazy town. But that's typically multi-exit entrepreneurs, some, who knows, they're they have the secret to eternal life, apparently. So those are crazy. But I would say for pre-product companies, like 4 or 4.5 is considered to be like pretty reasonable by most hardware investors that I talk to.
And that assumes a prototype and a little bit of traction.
Yeah, like ideally I'd love to see like, hey, we have these prototypes, so we made 10, we gave them to 10 people, they were held together by duct tape and they fell apart 10 times, so people love them anyway, and they can't live without them, and they won't give them back. Like, that's a dream scenario. I'm like, 4.5 valuation, like, let's do it, you know? So that's kind of the stage that we're talking about.
How many products have you already done, and what percentage were successful?
Sure, so we have 37 companies in our portfolio. Actually today, hopefully it's 38. Really excited about a deal hopefully we're gonna close on. Success right now, I mean, our portfolio looks really good on paper. We're too young to have like material cash-on-cash exits. But the kind of the two things that funds measure themselves on are, one, cash-on-cash returns, which we're too young to have any. And two is what's called IRR, and that's basically like how have the valuations of these companies improved over time, and that looks really good. And then we also think about, you know, who's raised follow-on capital, did they raise follow-on capital from good investors, are they shipping product, you know, how well are they doing in the market, and I think our fund performance is stellar.
So what are the advantages and disadvantages compared to, like, it seems like it's like always something fun that's a little bit on the lower side. It's pre-fun, right? So what's the difference between like doing a Kickstarter and doing something like this? I mean, I can see that you have more assets that I can use and all that, but what if you already had a workable product? It's already been tested, it's already going. Is it an advantage to go with like this, or is it an advantage to go with something like Kickstarter?
Sure, so I think that, so I have lots of friends at Kickstarter, and I think that they play like a super valuable role in the ecosystem. I think that if you like just want to birth a simple product into the world and you're not trying to be like the next Square, you know, like Kickstarter can be a super viable option as long as you've done your homework and make sure that you like understand your BOM, understand your COGS, and understand your full landed cost before pricing stuff out, understand shipping and logistics and timelines and manufacturing. Like, as long as you've got that stuff on lock, and what you're trying to do is like just bring something into the world, Kickstarter can be a great choice. I also think it's been an incredible democratizing force in terms of who can start businesses and small businesses, and that is like right on. So I think like crowdfunding can be great. I also think for venture scale or people who are trying to kind of be in our world, it can be an amazing launch tool. Pebble has proven this. You know, they've had great success with launching products on Kickstarter. They were, you know, well capitalized before they did that, but they used it as a launch tool. I think where people get into trouble is when they treat Kickstarter money like equity money. And maybe they can't raise money or they're not sure, and so they do a Kickstarter and, you know, they get maybe $1 million, but they're using that money to like pay their salaries and to fund product development, and the truth is there's just not enough money there to really deliver the product, and I think we've seen that play out in some pretty high profile flameouts. Coolest Cooler comes to mind, you know, one of the most successful crowdfunding campaigns in like the history of crowdfunding. And the truth is this shit's hard, you know, and so we really love Kickstarter if used correctly, and really understanding what that money is. It's not investment, it's really debt. Because basically people are giving you their money and you're promising them product, right? And so it's just, you know, understanding that money and how to treat it and use it responsibly. But I have lots of friends who have launched cool products and turned great, you know, and built great little businesses. And I think that's fantastic. But yeah, just like know your tools.
You had a question?
Yeah.
Hey, so from start to finish on average, how long does it take you all to make a decision and do an investment?
So that's a really good question. So maybe I'll take that as a chance to talk a little. Sorry. Yes, the question was from start to finish, how long does it take for us to make a decision or to make an investment? So I would say weeks, not months. but probably weeks. If it's a really hot deal and we really want to get it done and we want to, get in there, it might take 1 week. That's probably the fastest. I think we did one deal where it was like 2 phone calls, but that was really crazy. I don't know if we do it again. Don't tweet any of this, by the way. I'm giving you the real oh, no, it's not. Oh, shit. All right, whatever. For the most part, on average, I would say like 3 weeks. And that's because we do a couple of things. So I'll kind of tell you. So typically it starts with like a first meeting, and it's like, are you full of shit or are you not full of shit? Okay, you're not full of shit, so we're going to meet again. And I'm going to learn more and ask more questions. And then you have to talk to, like, I have to bring this back to the investment team. And I have to tell the rest of the investment team, okay, these people aren't full of shit. They're doing this cool thing. Seems cool. Should we talk to them more? And everyone's like, yeah, let's do it. So then you got to meet both the partners, right? And their schedules are crazy, right? So then you're meeting with the partners. You got to convince one partner and the other partner, sometimes together if you're lucky. But then for us, we also want to do an engineering meeting, right? Because we want to understand more depth about your product. We also want you to know us. And we need to make sure that this is a good relationship, right? So then we decide to do the deal. So that probably took 2 weeks, right? So then we're like, okay, we want to do this deal. Then we got to negotiate the deal, right? And that can go fast. That can go like, this is what we want to do. Yeah, we like these terms. Check with your lawyer. We'll check with ours. Let's sign it. That can be 36 hours. Or I think the longest deal we negotiated was like 3 months. Like, I love the company. I'm so glad they're in our portfolio. I was actually friends with them before we invested. But they were just, they wanted the fine-tooth comb, and so that's what we did. And so that, that was really driven by them. So the deal process anywhere from as little as, a week to multiple months, but typically we get to a decision within a couple of weeks. If it's taking longer than that, like if you're not getting moved down that pipeline, it probably means you're not a priority. So another thing you want to understand too is like, when are VCs truly interested and when are they just kind of, hanging on to you and not getting back to your emails? Typically you want to see yourself being moved through that process quickly. And so to me that's a matter of like, quick follow-ups and scheduling the next thing. Like it might take a couple of days to get that next thing scheduled, but like the scheduling's happening quickly. Like there's kind of like this cadence that develops. Communication picks up over time instead of slowing down. So those are all good signs. And then meeting multiple people within the firm. Last question in the back.
So do you ever have problems sourcing very strong manufacturers, lean, quality, been through lots of industries, great experience that helps your folks in different industries to not only build, but know what they're doing from military to healthcare applications?
Yeah, so I think yes and no. It's always a process to find the right manufacturing partner. For us in the early days, often what we're doing with companies is helping them make the first 20, 50, 100, 200, and we've developed like a pretty good network of partners like that we love for plastics, that we use for PCBs or whatever. Like we kind of have people that, and they know us, so they make things go fast and easy and it's good quality. But that's for early days. When you start thinking about your first large run, assuming that your business requires producing a lot of product. Not all good businesses require producing a lot of product. We have a really good relationship with a firm called Dragon Innovation. One of our partners, he's a special partner, is Scott Miller, and he's the CEO at Dragon. He was the VP engineering at iRobot and built the Roomba to insane volumes, great guy. So what they do is they actually help people go through the RFQ or request for quote process and select the correct manufacturer, typically in Southeast, or typically in sort of the Shenzhen area, Pearl River Delta area in China, for kind of consumer electronics-y type things. That's a consulting business. It's not part of Bold. It's a separate thing. But we have a good relationship with them. And so when people are ready to really select their manufacturer, typically we'll refer them to someone like Dragon, or they'll use someone else, or do it themselves and then regret it later. That also happens. Not gonna lie. Cool. Thanks, guys. Thanks for having me. Thanks, Jade.
Kate will be hanging around here after we adjourn. At this point in the evening, want to kind of open up for general announcements. I know a couple of you have some things to say, but before I forget, first thing I want to do is let Dennis in the corner stand up. I sent an email to everyone here that Dennis was offering some freebies. So how do you want to do this at the very end, Dennis, orderly, for people to come and claim their Zamzy? Cool. Thanks, and thanks for doing that. Where's Jerry? Jerry, come on up and you can have the next one. Then just raise your hand if you want to just come up and say hi, introduce yourself, or if you have any other announcements.
And I'm about to say one of Kate's favorite words for IoT. There's the Austin IoT meetup this coming Tuesday at Sherlock's on Research at 7 p.m. My company, Cogswell.io, is at Albuquerque, New Mexico, but we're flying in one of our developers. Cogswell.io is a IoT developer platform, so if it's very good, it's going to be very technical. But if you have any other questions, just come up to me after the meetup. I'll talk to you. Bye.
At the beginning of that, part of that same meeting, also we'll see a demonstration from Cherry, who has
Cherry switches.
Cherry switches, which have got power harvesting switches. So the switches actually have no batteries in them.
And that's Tuesday at Sherlock's, what time?
7 p.m.
7 p.m.
Is that on
At
Meetup?
the IoT meetup.
IoT, Austin IoT.
Anyone else want to come say hi, say a few words? No? Guys, thank you all for coming. One request I have is just to clean up the trash around you so that your humble organizer and the staff at Capital Factory don't have to do that. And feel free to get some more drinks and schmooze for a little bit. Thanks for coming. So it's not like it is recorded. We don't have to.
Oh, that's fine. It's actually totally fine.
I always ask you.
Yeah.
I'll send you a name.
Okay, cool. Oh, thanks.
Yeah, I'm gonna get out of the way.
Okay. All right, yeah, just steal that. Steal that. Yeah.
I'll give you a card.
Okay, thank you.
Thanks for you. Great
Sure.
presentation. Very
Yeah,
good.
my pleasure. Hey, Michael, nice to meet you.
Usually got hardware with
Okay.
right now.
Okay. Okay.
We're not creating a mini we're
Yeah.
taking 16 pieces where we're making it into different pieces. And kind of a premium service, top-notch hardware, and do everything that you were listening to.
So I think the difficulty with something like this is I think this is what Tesla and Uber are planning to do. And so you're going into a super competitive space. Yeah, but I'm not trying to argue with you. I'm just saying I think the difficulty from the investment side is that I think people would see Uber and Tesla as direct competitors, and so you'd have to figure out, how do you navigate around that? Like, how do you win against that? And do you want to compete with them, or is there a different route that you're going to take, or win a specific market, Okay, so sorry, I was thinking autonomous, so not autonomous. Okay, I just assumed autonomous, sorry.
Yeah.
Okay. Okay.
Yeah, we just take a mile away.
Okay. Good. So maybe your advantage is first mover advantage. Okay. Cool. Great. Well, nice to meet you. Yeah, please do. Yeah. Just send it through the website and say that you were
Not that email address, Kate had.
No, it will get lost in my email. If you send it through the website, it'll go into the feed of things to review, and so it'll get done. Okay. Yeah. Nice to meet you. Hi. Nice to meet you. Okay. Like computer vision or like machine. Okay. Yeah.
Now my question to you is actually kind of personal.
Yeah.
Like, why would you need digital help?
Oh yeah.
Because we want, my vision is to
does serial sectioning of tissue samples, and creates like 3D reconstructions of the tissues, right? So I left Digital Hall because I got the opportunity to work, and I was really interested in what they were doing. The company that I was referring to is a hardware company, and so I'd gotten kind of excited